They operate in silence. They move trillions without the public ever seeing a single transaction. And when they fail, entire economies fall with them. This is the shadow banking system, the financial machine built in the dark. Shadow banking emerged long before the public understood its scale or influence, and long before regulators realized that a parallel financial universe had quietly formed beneath the surface of the global economy. It began as a workaround, a way for lenders and investors to operate outside the rigid framework of traditional banks, which were constrained by capital requirements, liquidity rules, and government oversight. As financial markets expanded in the late 20th century, institutions sought new pathways to generate returns without the scrutiny that accompanied formal banking activity. What started as small, obscure investment vehicles eventually evolved into a sprawling network of entities controlling trillions of dollars in credit, operating with almost no transparency. The term shadow banking was first used by analysts in the early 2000s to describe financial intermediaries that looked like banks, acted like banks, and moved money like banks, but were not banks in the regulatory sense. These institutions included hedge funds, money market funds, securitization vehicles, private lending firms, and complex investment products that blended traditional finance with high-risk speculation. They issued credit, packaged loans, traded debt instruments, and borrowed heavily from one another, creating a dense and invisible web of obligations. In many countries, these entities grew faster than regulated banks because they faced fewer constraints and offered higher returns to investors willing to accept the risks hidden behind complex financial structures. One of the earliest warning signs appeared during the global financial crisis of the late 2000s. When the American housing bubble burst, the collapse was not limited to traditional banks. It was the shadow banking system, particularly institutions that packaged subprime mortgages into opaque securities, that amplified and transmitted the shock across the world. Economists later concluded that these hidden networks were responsible for accelerating the spread of the crisis through global markets. Yet instead of shrinking after the meltdown, shadow banking expanded even further. Investors, searching for yield in a low interest rate environment, poured money into funds and lending platforms that promised attractive returns. These entities grew rapidly, especially in regions where financial regulation lagged behind innovation. By the early 2020s, estimates suggested that the global shadow banking sector controlled more than a quarter of all financial assets worldwide. Major central banks, including those in Europe, North America, and Asia, published reports acknowledging that the size and complexity of these networks pose potential risks to global stability. But despite these warnings, regulators struggled to keep pace with financial engineering. New products emerged constantly: structured credit instruments, leveraged loan pools, private debt funds, and offshore vehicles that operated without geographic or legal boundaries. Each layer added opacity to the system, making it increasingly difficult for outsiders to understand who owed what and to whom. The appeal of shadow banking varied across regions. In the United States, large corporations relied on non-bank lenders to secure short-term funding through commercial paper markets. In Europe, pension funds and asset managers turned to private credit firms to achieve returns that safer investments could not provide. In emerging markets, shadow banking filled gaps left by underdeveloped financial systems. China, in particular, saw explosive growth in trust products and wealth management vehicles that funneled money into high-risk real estate projects. These instruments allowed developers to borrow on a massive scale, bypassing the restrictions placed on formal bank loans. The Chinese shadow banking ecosystem evolved into a giant parallel economy that played a central role in the country's rapid urban expansion and its subsequent slowdown. International news coverage increasingly highlighted the dangers of this hidden world. Journalists exposed scandals involving private lending platforms that collapsed after promising unrealistic returns. Regulatory investigations revealed cases where funds had used investor money to cover previous losses, creating hidden Ponzi-like structures. In several countries, authorities discovered that shadow institutions had lent heavily to politically connected firms, raising concerns about corruption and favoritism. These revelations underscored a troubling reality. Shadow banking thrived on secrecy, complexity, and the absence of accountability. The global pandemic exacerbated these risks. When markets froze, many shadow institutions lacked access to emergency support because they were not part of the regulated banking sector. Some faced liquidity crises, unable to meet withdrawal requests or roll over short-term debt. Governments responded with unprecedented interventions, but these measures highlighted the fragility of a system that relied on continuous borrowing to remain stable. Economists warned that without substantial reforms, shadow banking could become a trigger for future crises, especially as interest rates rose and debt burdens increased worldwide. Despite these concerns, shadow banking remained deeply embedded in the global economy. Corporations, investors, and even governments relied on its liquidity. Its flexibility allowed it to respond faster than regulated banks to changing market conditions, and its profits attracted some of the world's largest financial institutions. But this integration also meant that a failure within the shadow system could cascade through traditional banks, capital markets, and national economies. Analysts described it as a fault line, invisible beneath the surface, silent when stable, but capable of triggering seismic disruption if stressed. As the world entered a period of heightened economic uncertainty, the influence of shadow banking became impossible to ignore. Economists, regulators, and investors recognized that understanding this hidden system was essential to grasping the full picture of global finance. The risks it held, the power it accumulated, and the secrecy it maintained all pointed to a deeper issue: a world economy increasingly dependent on mechanisms that operated outside the light. The explosive growth of the shadow banking system was not an accident of modern finance, but the predictable result of a world increasingly dependent on credit, speculation, and rapid capital movement. As traditional banks tightened regulations following the global financial crisis, money began flowing toward institutions that operated beyond oversight. In the United States, investment funds and non-bank lenders expanded dramatically as corporations sought alternatives to conventional loans. These institutions offered flexible terms, faster approval processes, and access to capital that avoided the scrutiny attached to federally regulated banks. By the early 2020s, analysts estimated that private credit funds alone controlled assets worth several trillions of dollars, making them one of the fastest growing forces in global finance. Europe followed a similar trajectory. After years of economic stagnation and ultra-low interest rates, pension funds and insurance companies searched aggressively for higher returns. They channeled money into private debt markets, securitization vehicles, and offshore finance structures that promised better yields than government bonds or traditional savings products. Regulators observed that many of these instruments operated across multiple jurisdictions, making oversight fragmented and inconsistent. Reports from financial watchdogs warned that Europe's shadow lending activity had grown to rival parts of the official banking system, yet remained far less transparent. Meanwhile, in emerging markets, shadow banking filled the void left by underdeveloped financial institutions. Small businesses and households struggled to obtain credit from traditional banks, which often focused on large state-owned enterprises or well-established corporations. Private lenders, microfinance platforms, and informal credit networks stepped in to meet demand. Some of these institutions provided legitimate services, but many operated with predatory interest rates or inadequate risk management. In several countries, authorities discovered that shadow lenders had extended enormous amounts of credit to politically influential individuals, masking the full scale of public and private debt. No country, however, saw a more dramatic expansion of shadow finance than China. Beginning in the early 2000s, the country experienced a surge in economic activity driven by rapid industrialization and urbanization. Traditional banks, mostly state-owned, were unable or unwilling to provide the volume of loans that private companies needed. As a result, trust companies, wealth management products, and private lending networks grew at extraordinary speed. By the mid-2010s, Chinese shadow banking had become so large that it influenced national monetary policy. Economists noted that the total value of shadow credit rivaled that of formal bank lending, yet much of it remained hidden behind layers of corporate structures, local government financing vehicles, and off-balance sheet arrangements. China's real estate boom played a central role in this growth. Developers relied on trust products to bypass lending restrictions, using the funds to acquire land, launch new projects, and refinance old debts. Wealth management products offered high returns to investors and promised safety backed by the reputation of state-linked institutions. But in reality, the money was often funneled into high-risk developments that depended on constant sales to remain solvent. When property markets slowed, The consequences rippled through the shadow banking system, exposing vulnerabilities that regulators had been unable to address. International organizations, such as the International Monetary Fund and the Financial Stability Board, issued repeated warnings about the rapid expansion of global shadow banking. Their reports highlighted that non-bank financial institutions now played a critical role in corporate borrowing, mortgage lending, securities trading, and short-term funding markets. Yet these activities operated outside the layers of protection that shielded traditional banks from sudden shocks. In several instances, shadow lenders had become so deeply interwoven with official financial systems that regulators feared intervening too aggressively, worried that disruptions might trigger broader instability. News outlets around the world published investigations into the opaque operations of shadow institutions. Journalists uncovered how some American hedge funds used complex derivatives to influence corporate debt markets, how European investment vehicles quietly financed risky loans in developing countries, and how Asian property developers relied on offshore financing to circumvent domestic restrictions. These revelations painted a picture of a global financial landscape where enormous sums of money move through channels designed to avoid detection. The rise of financial technology accelerated this transformation. Online lending platforms, decentralized finance protocols, and blockchain-based investment products offered new avenues for borrowing and lending outside traditional regulations. While some innovations increased access to credit, others introduced new risks. Analysts warned that digital shadow banking could amplify volatility as investors and borrowers interacted anonymously without the safeguards typically enforced by regulators. Several countries recorded cases where online lenders collapsed suddenly, leaving thousands of borrowers and investors without recourse. Despite these dangers, shadow banking continued to grow because it satisfied a universal demand: the desire for higher returns, faster credit, and fewer constraints. Investors seeking profit embraced complex financial engineering, while corporations and households turned to non-bank lenders when traditional institutions could not meet their needs. Regulators struggled to monitor these interconnected networks, often discovering problems only after significant damage had occurred. The system expanded not because it was stable, but because it was profitable, and because the true risks remained hidden from public view. By the early 2020s, it had become clear that shadow banking was no longer a peripheral phenomenon, but a fundamental pillar of global finance. Economists argued that understanding the modern economy required understanding the shadow system behind it: the unregulated credit engines, the offshore structures, the complex securitizations, and the financial innovations that operated outside the reach of conventional oversight. The more the system grew, the more the world depended on it, and the greater the danger became if it ever began to fail. Shadow banking has played a central role in some of the most significant financial crises of the modern era, often acting as the invisible accelerant behind collapses that appeared sudden only to the public. Its influence became undeniable during the American housing crisis of the late 2000s. While traditional banks issued many of the risky mortgages that fueled the bubble, it was the shadow institutions that transformed those loans into complex securities. Firms outside the regulatory perimeter packaged subprime mortgages into collateralized debt obligations that masked the true level of underlying risk. Investors around the world purchased these products, believing they were safe because rating agencies, influenced by flawed models and conflicts of interest, assigned them high grades. When homeowners began defaulting at unprecedented levels, the securities imploded, sending shockwaves through every corner of global finance. Economists later concluded that without the shadow banking machinery, the crisis would not have spread with such devastating speed. The fallout did not end with the American meltdown. In Europe, the sovereign debt crisis of the early 2010s revealed another dimension of shadow banking's reach. European banks had used off-balance sheet vehicles to purchase government bonds from countries such as Greece, Portugal, and Spain. These vehicles relied heavily on short-term borrowing from money market funds, many of which operated outside strict regulatory oversight. When confidence weakened, the funds refused to roll over loans, leaving banks scrambling to secure liquidity. The sudden freeze exposed vulnerabilities that had been hidden behind years of financial engineering. Governments and central banks were forced to intervene on a massive scale, but the reliance on shadow mechanisms meant that no one fully understood the extent of the contagion until it was too late. Asia faced its own reckoning. China's shadow banking system became deeply entangled with the country's real estate boom, contributing to one of the most significant credit expansions in modern history. Trust companies issued wealth management products that promised unusually high returns. These products financed land purchases, construction projects, and local government spending, creating a cycle of dependency that appeared sustainable only as long as property prices continued rising. When sales slowed in the late 2010s, the entire structure began to falter. Developers defaulted, trust products failed, and households discovered losses they never imagined possible. The public outcry grew as families, retirees, and small investors realized they had unknowingly participated in a shadow credit machine that prioritized rapid growth over transparency. International organizations began publishing detailed warnings. Reports from the International Monetary Fund and the Financial Stability Board described shadow banking as a systemic blind spot, noting that global non-bank institutions held a growing share of credit that far exceeded the size of many national economies. Financial analysts highlighted that shadow banking had become so pervasive that crises in one region could quickly spill into others. This interconnectedness became evident when several emerging markets experienced sudden capital outflows in the mid-2010s. As interest rates in developed countries rose, investors withdrew money from offshore lending networks, triggering currency depreciation and severe financial stress in nations such as Turkey, Argentina, and South Africa. Shadow institutions had extended large amounts of dollar-denominated credit to borrowers in these countries, leaving them vulnerable when global liquidity dried up. At the same time, Latin America witnessed a different but related phenomenon. Private debt funds and offshore lenders increasingly targeted the region's corporations, offering loans at attractive rates but with stringent repayment terms. When commodity prices collapsed in the mid-2010s, many of these companies struggled to service their debts. Several high-profile defaults exposed how deeply foreign shadow institutions had penetrated local economies. Governments and regulators found themselves powerless to intervene because the loans existed outside domestic legal frameworks. This fragmentation underscored a core problem. Shadow banking could operate across borders without accountability, leaving national authorities unable to respond effectively during times of stress. Even advanced economies were not immune. In the United Kingdom, the failure of several major funds during the late 2010s sparked public debate about the lack of oversight in asset management industries. One high-profile collapse involved a fund that had used shadow mechanisms to mask liquidity risks. When investors attempted to withdraw money, the fund froze redemptions, igniting a scandal that dominated financial headlines. Regulators admitted that they had underestimated the potential dangers posed by non-bank financial institutions, especially those dealing in complex debt instruments. Global news outlets repeatedly highlighted these events as warnings of deeper systemic fragility. Journalists uncovered cases of corporate debt tied to opaque investment vehicles in the United States, European banks quietly offloading risky assets into offshore structures, and Asian conglomerates using shadow lenders to finance aggressive expansion. Each revelation showed how shadow banking amplified risk by allowing borrowing and lending to occur outside regulated systems. Economists argued that while traditional banks remained critical to global finance, it was the shadow institutions, hedge funds, private credit firms, money market funds, securitization vehicles, that increasingly shaped the flow of global capital. The rise of shadow banking also influenced government debt markets. Countries with high fiscal deficits relied on non-bank institutions to purchase large quantities of government bonds, believing that diversified demand reduced reliance on foreign creditors. But this increased dependence on shadow entities created hidden vulnerabilities. During periods of market stress, these institutions could rapidly withdraw, dumping bonds and causing yields to rise sharply. Several countries in Europe and Asia experienced such shocks, leading to emergency interventions by central banks to stabilize bond markets. These events demonstrated how quickly global liquidity could evaporate when shadow lenders retreated. Moreover, the expansion of shadow banking intersected with the growth of global derivatives markets. Institutions outside traditional banking channels increasingly traded credit default swaps and other complex instruments that magnified risk. When volatility spiked, these instruments triggered massive margin calls that forced institutions to liquidate assets. This pattern played out during multiple financial episodes in the early 2020s, illustrating how shadow mechanisms intensified market swings. Analysts argue that as long as trillions of dollars moved through unregulated channels, crises would continue to emerge unpredictably. As the global financial system became increasingly entangled with shadow mechanisms, crisis events grew more multifaceted and more difficult for regulators to contain. One of the most striking examples occurred in the early 2020s, when several major hedge funds in the United States unraveled after placing highly leveraged bets across multiple markets. These funds had borrowed vast sums from prime brokers, which themselves relied on short-term financing from other non-bank institutions. When asset prices moved unexpectedly, the funds faced enormous margin calls. Their rapid liquidation cascaded across markets, causing volatility in equities, bonds, and derivatives simultaneously. Investigations later revealed that the scale of leverage had been obscured by layers of rehypothecation, where the same collateral was pledged repeatedly within shadow networks. Regulators admitted that they had no clear visibility into the true exposure because the trades occurred outside traditional banking oversight. A similar dynamic unfolded in Europe, where pension funds found themselves unexpectedly vulnerable during a period of extreme bond market volatility. These funds had used liability-driven investment strategies that depended on derivatives and leveraged instruments offered by shadow institutions. When yields surged over a short period, the funds faced liquidity shortages that threatened their ability to meet obligations. Central banks were forced to intervene to stabilize markets, an action that underscored how deeply shadow structures had infiltrated institutions traditionally seen as safe. Analysts warned that such vulnerabilities would likely reappear unless systemic reforms addressed the opacity of non-bank financial activities. In Asia, shadows extended not only across real estate, but into corporate borrowing and wealth management. Japan, long cautious about financial instability after its own asset bubble collapse, faced renewed concerns as private credit firms expanded aggressively into corporate debt markets. These firms offered loans to companies that struggled to borrow through traditional banks. Although they filled an important gap, their opaque operations made it difficult for regulators to assess the true level of risk in the system. Observers noted parallels between the Japanese shadow lending boom and the American subprime crisis, emphasizing that excessive reliance on unregulated credit sources could create hidden vulnerabilities. India experienced similar challenges. As one of the world's fastest growing economies, it relied heavily on non-bank financial companies to support consumer lending, housing finance, and small business credit. When a major non-bank lender collapsed in the late 2010s, it triggered widespread panic. Investors withdrew funding from other shadow institutions, leading to a liquidity freeze that pressured banks, businesses, and households. The government intervened with emergency measures, but the episode revealed how critical shadow lending had become for economic activity. Financial analysts pointed to the event as a stark reminder of how a single failure in the shadow sector could destabilize entire markets. Latin America continued to struggle with the consequences of its reliance on offshore lenders and private debt funds. In Brazil, several companies defaulted after borrowing heavily from shadow firms at interest rates that assumed constant growth in commodity markets. When prices fell, these companies faced insurmountable repayment burdens. Meanwhile, in Mexico, regulators discovered that certain shadow institutions had extended credit to politically exposed individuals in exchange for favorable treatment. The scandal exposed systemic corruption and highlighted how shadow finance could undermine governance. International observers expressed concern that such practices weakened institutional trust and made financial crises more likely. Africa too saw growing risks associated with shadow banking. In South Africa and Nigeria, private lenders and informal credit networks expanded rapidly as traditional banks failed to meet the needs of small enterprises and consumers. Some of these lenders operated legally, but many engaged in predatory practices offering high-interest loans without adequate risk assessment. When economic conditions deteriorated, borrowers defaulted in large numbers. The resulting losses spread across communities and undermined local economies. Development organizations warned that shadow credit expansion without proper oversight threatened long-term financial stability across the continent. Despite regional differences, a common pattern emerged. Shadow banking consistently amplified financial stress. It created cycles of leverage that depended on continuous liquidity and investor confidence. When stability was disrupted, even briefly, credit channels seized up, forcing institutions to unwind positions at speed. This dynamic contributed to violent swings in global markets, often catching regulators off guard. Economists noted that the ability of shadow institutions to move enormous volumes of capital quickly, without the safeguards imposed on banks, meant that small shocks could escalate into major crises. Technology further increased these risks. The rise of decentralized finance introduced platforms where borrowing, lending, and trading occurred without intermediaries or regulatory oversight. While proponents hailed these innovations as democratizing finance, critics warned that they enabled speculative excess. Several decentralized lending protocols collapsed after stablecoin failures and price manipulation events. Users lost substantial funds, and the crashes reverberated through online lending networks worldwide. Governments began drafting regulatory frameworks for digital assets, but the speed of innovation consistently outpaced policy development. Meanwhile, multinational corporations leveraged shadow channels to optimize balance sheets and reduce tax liabilities. They routed funds through offshore vehicles, special purpose entities, and complex financing arrangements that obscured true debt levels. When markets tightened, corporations reliant on such mechanisms faced sudden liquidity shortages. Analysts drew parallels with the collapse of major American energy companies in the early 2000s, where opaque financial structures hid massive liabilities until the firms imploded. Shadow banking allowed similar patterns to resurface on a global scale. The interconnected nature of shadow finance meant that shocks in one region could quickly propagate across borders. For instance, when Chinese trust products began failing, investors in other Asian countries withdrew funds from similar structures, fearing contagion. This withdrawal triggered liquidity issues in Taiwan, South Korea, and parts of Southeast Asia. Similarly, when American hedge funds unwound positions, European markets reacted sharply, demonstrating how globalized the shadow network had become. Money flowed freely across jurisdictions, but oversight did not. Central banks acknowledged these systemic risks, but their tools were limited. They could stabilize markets temporarily by injecting liquidity or purchasing assets, but they could not regulate institutions beyond their jurisdiction. Shadow banking, by design, existed outside the reach of any single authority. This fragmentation created a regulatory vacuum, allowing risks to build until they erupted in crisis. By the early 2020s, financial scholars increasingly argued that shadow banking had become the defining challenge of global financial stability. Its influence touched every part of the economy: housing, corporate borrowing, government debt, consumer credit, and investment markets. Crises were no longer isolated events within national boundaries, but interconnected failures driven by hidden leverage and opaque financial engineering. Each episode revealed the same truth. Whenever vast amounts of capital move in darkness, the consequences eventually emerge in the light. Regulators around the world have spent decades attempting to contain the rise of shadow banking, yet each intervention has revealed the same uncomfortable truth. The system is too large, too fragmented, and too deeply embedded in global finance to be brought under full control. Traditional regulation was designed around banks holding deposits, issuing loans, and maintaining reserves. But shadow institutions do none of these things in the conventional sense. They borrow from investors, lend to corporations, trade securities, and package debt into increasingly complex structures, all while avoiding the safeguards imposed on formal banking. As financial innovation accelerated, regulators found themselves chasing a moving target, always reacting to crises rather than preventing them. One of the biggest obstacles regulators face is the speed at which shadow markets evolve. When authorities tighten rules in one sector, shadow institutions shift activity to another. After the American financial crisis, reforms targeted securitization practices and mortgage standards. Yet, within a few years, private credit funds and non-bank lenders expanded dramatically, offering leveraged loans to corporations that traditional banks could no longer support. These loans often carried fewer protections for investors and placed heavier burdens on borrowers, creating vulnerabilities that analysts warned resembled pre-crisis patterns. Regulators acknowledged these risks but hesitated to intervene, knowing that corporations depended on these credit channels to finance operations and investments. Another challenge lies in jurisdictional boundaries. Shadow banking is inherently global, transcending national borders and legal frameworks. A fund registered in one country may lend to companies in another, while borrowing from investors in a third. Offshore financial centers play a critical role in this ecosystem by offering legal structures that obscure ownership and leverage. Regulators in individual countries can supervise domestic institutions, but have limited authority over foreign entities operating through local markets. This fragmentation creates enforcement gaps where risky practices flourish unchecked. Even coordinated efforts by international organizations struggle to close these gaps because each jurisdiction has its own political and economic priorities. Shadow institutions also enjoy powerful political influence. Their operations generate enormous profits for investors, corporations, and asset managers. As a result, lobbying groups push back against stricter regulations, arguing that non-bank finance supports economic growth and expands access to credit. Some governments welcome shadow banking because it enables investment without placing pressure on domestic banks. In emerging markets, shadow lenders support infrastructure projects and consumer spending, making them attractive to policymakers seeking rapid development. Attempts to impose tighter restrictions often face resistance from both industry players and political leaders, who view shadow finance as essential to national competitiveness. Technological innovation complicates the landscape further. Digital lending platforms, algorithmic trading systems, and decentralized finance protocols have introduced new forms of shadow banking that operate at speeds regulators cannot match. Automated trading can shift billions of dollars across markets in fractions of a second, amplifying volatility. Online lending apps issue loans without requiring traditional credit checks, exposing users to high-interest debt cycles. In the world of decentralized finance, borrowing and lending occur through smart contracts that exist outside any regulated institution. Regulators must confront these technologies without stifling innovation, a balancing act that has proven extraordinarily difficult. Attempts to impose rules on digital finance often trigger industry backlash, driving activity deeper into unregulated spaces. The opacity of shadow banking represents another profound challenge. Traditional banks report detailed financial information to regulators and must maintain clear capital ratios. Shadow institutions, by contrast, often provide minimal transparency. They may disclose only aggregated data or operate through complex layer structures that hide true leverage and risk exposure. Even when regulators possess the authority to request information, they may not receive accurate or complete data. Analysts describing the system often refer to it as a black box, noting that its internal mechanisms remain invisible until a crisis exposes them. China's experience illustrates how regulatory pressure can sometimes worsen shadow risks. When authorities sought to reduce leverage in the formal banking sector, developers and corporations simply shifted borrowing to trust companies and wealth management products. These shadow channels expanded rapidly, financing high-risk projects that banks refused to support. When the property market weakened, regulators found themselves confronting a crisis far larger than they had anticipated. The government attempted to rein in shadow financing, but by then the system had grown too substantial to unwind without causing widespread economic damage. The European Union faces a different but equally complex challenge. Its financial markets rely heavily on asset managers and investment funds that perform functions traditionally carried out by banks. These funds purchase corporate bonds, securitize assets, and provide liquidity in debt markets. However, during periods of market stress, funds may withdraw from markets suddenly, leaving companies unable to refinance debt. Regulators have proposed imposing liquidity requirements and redemption restrictions on these funds, but implementation has been slow due to political disagreements among member states. Meanwhile, shadow activity continues to expand, increasing the potential severity of future crises. Even in the United States, where post-crisis reforms strengthen oversight of major banks, shadow institutions remain a dominant force. Money market funds, private equity firms, hedge funds, and structured finance vehicles all contribute to credit creation outside the banking sector. When volatility spikes, regulators must intervene indirectly by supporting markets rather than supervising individual institutions. Central banks have repeatedly provided emergency liquidity to stabilize systems that, technically, they do not regulate. This paradox, supporting shadow markets while being unable to control them, highlights the structural limitations of modern financial oversight. Ultimately, regulators struggle not because they lack the will to act, but because shadow banking has become woven into the fabric of global finance. It supports corporate borrowing, fuels investment strategies, and enables governments to manage debt. Attempting to restrict it would slow economic growth, undermine business confidence, and provoke political backlash. Yet allowing it to operate unchecked permits risks to accumulate until a crisis forces sudden and drastic intervention. This tension defines the regulatory dilemma. To regulate too little invites catastrophe, but to regulate too much risks destabilizing the economy in different ways. The world now faces a financial landscape where the largest threats lie not in regulated banks, but in the vast, unmonitored networks operating around them. Shadow banking thrives in complexity, adapting rapidly to new regulations, new technologies, and new market conditions. It is a system built to avoid confinement, and one that regulators have never fully understood, let alone controlled. As global markets grow more interconnected, the consequences of regulatory failure become more severe, making the dark side of finance not just a theoretical risk, but a persistent and growing reality. The global threat posed by the shadow banking system lies not only in its size, but in its invisibility. Unlike traditional financial institutions, whose vulnerabilities can be tracked through balance sheets, capital ratios, and regulatory disclosures, shadow networks operate behind layers of complexity that even seasoned analysts struggle to decipher. This opacity means that crises often emerge without warning. Investors may assume that markets are stable, while hidden leverage accumulates silently, forming pressure points that can erupt with devastating force. The inability to measure risk accurately has become one of the defining challenges of modern finance, creating a world where economic stability rests on foundations no one can fully see. The scale of the system is itself a source of risk. Estimates from global financial watchdogs suggest that non-bank financial intermediaries now control assets worth more than those held by many of the world's largest banking sectors. Money market funds, private credit firms, hedge funds, structured finance vehicles, and offshore entities collectively manage trillions of dollars that flow through markets daily. These institutions are deeply interconnected, borrowing from one another, trading securities across borders, and participating in liquidity cycles that depend on continuous investor confidence. When that confidence falters, the system can seize up abruptly. This happened during the early months of the global pandemic, when investors rushed to withdraw money from non-bank funds. Markets froze, bond yields spiked, and central banks in multiple countries were forced to intervene to prevent a collapse of short-term funding markets. Another major risk arises from the nature of shadow lending itself. Many shadow institutions engage in maturity transformation, borrowing short-term money to invest in long-term assets. This strategy can generate profits during stable conditions, but becomes dangerous when liquidity dries up. Without access to emergency funding, which traditional banks can obtain through central bank facilities, shadow lenders face sudden insolvency. This dynamic played out in several European and American funds that collapsed after failing to meet redemption requests. Their failures sent ripples through global markets, demonstrating how the breakdown of a single shadow institution can trigger chain reactions affecting unrelated sectors. Corporate debt represents another critical fault line. Over the past decade, non-bank lenders became the primary source of credit for companies unable to secure loans from traditional banks. This expansion fueled record levels of corporate borrowing, particularly in the United States, Europe, and parts of Asia. Many companies issued high-yield bonds or obtained leveraged loans with minimal investor protections, deals that shadow institutions eagerly financed. Analysts warn that this buildup of risky debt created significant vulnerabilities. If economic conditions weaken, heavily indebted corporations may default in large numbers, undermining investment funds, pension plans, and financial markets globally. The interconnected nature of shadow debt instruments means that even localized corporate failures could spill into international markets. Emerging markets face additional dangers. Many countries rely on shadow channels for external financing, particularly through offshore, dollar-denominated loans offered by private credit funds and non-bank lenders. These loans expose borrowers to currency risks. If local currencies weaken, repayment costs rise dramatically. During periods of global tightening, investors often pull money from higher-risk markets, causing currencies to depreciate and increasing the burden on borrowers. Several nations experienced this cycle repeatedly in the past decade, leading to inflation spikes, capital flight, and severe financial stress. International observers warn that as global interest rates rise, emerging markets may once again face waves of shadow-driven instability. Technology continues to amplify these risks. Decentralized finance introduced new forms of leverage and liquidity creation that operate entirely outside traditional oversight. While some innovations provide legitimate services, many have enabled speculative bubbles fueled by opaque financial engineering. The collapse of several digital lending platforms and stablecoins demonstrated how quickly confidence can evaporate in unregulated systems. The speed at which digital assets can be moved, sometimes within seconds, increases the likelihood of sudden market crashes. Regulators have begun drafting frameworks for digital finance, but the rapid pace of innovation ensures that risks will continue to outpace oversight. Environmental and geopolitical factors further complicate the global landscape. As countries transition toward greener economies, billions of dollars flow through shadow channels into renewable energy projects, carbon credit markets, and climate-linked financial products. These investments often involve complex derivatives and private lending structures that remain poorly understood. If climate-related assets experience sudden revaluations, shadow institutions heavily involved in these markets could face significant losses. Meanwhile, geopolitical tensions increase uncertainty, prompting investors to reposition assets rapidly across global markets. Shadow institutions, with their speed and flexibility, often drive these flows, amplifying volatility during already unstable periods. The most profound threat, however, lies in the interconnectedness of the entire system. Shadow banking is not separate from the global economy. It is woven into it so deeply that the failure of one component can destabilize others. Traditional banks rely on shadow institutions for liquidity and asset management. Corporations depend on them for credit. Governments count on them to purchase debt. Pension funds rely on shadow investments for returns. Central banks intervene to stabilize markets influenced largely by shadow activity. This web of dependency means that shadow banking is not merely a parallel system. It is a core pillar of global finance, yet one without the foundational safeguards that protect traditional banking. Analysts increasingly warn that the next global financial crisis may not originate in traditional banks at all. Instead, it may emerge from the places least visible to the public: private credit markets overloaded with risky loans, hedge funds sitting atop layers of hidden leverage, money market funds exposed to sudden redemptions, or digital platforms vulnerable to liquidity evaporations within minutes. Each of these scenarios has precedent in recent history, and each highlights the fragility of a system built on opacity and speed. As nations confront rising debts, slowing growth, and tightening monetary conditions, the pressure on shadow institutions intensifies. In such an environment, small shocks can become global emergencies. The collapse of a major non-bank lender, a sudden withdrawal from a key money market fund, or a disruption in offshore financing networks could cascade through markets with unprecedented speed. Regulators, economists, and policymakers acknowledge these dangers, yet the complexity of the system makes comprehensive reform difficult. Shadow banking has become a defining feature of 21st century finance, a system born in the dark, expanded through innovation, and globalized by demand for yield. Its power is undeniable, its influence pervasive, and its risks unavoidable. The world has built an economy dependent on institutions the public cannot see and regulators cannot fully control. As global financial pressures mount, the question is no longer whether the shadow system poses a threat, but when and how that threat will emerge. This system was built in darkness. It thrives on complexity, secrecy, and the belief that no one will ever look too closely. But when shadow banks collapse, they don't fall alone. They pull nations down with them. If you want to see the forces that truly shape global finance, stay with us, because the most powerful systems on Earth are the ones hidden in the shadows. Shadow Rewind continues.